Welcome to this explainer. Okay, today we're looking at the absolute heartbeat of a successful enterprise. I'm talking about bookkeeping. We're going to trace the life cycle of a single business transaction and, really watch how raw, chaotic data gets transformed into a perfectly balanced ledger. I want you to picture your everyday reality in business. You're constantly buying, selling, paying electricity bills, depositing checks. It's just a total flurry of activity, right? But where does all that chaotic data actually go? Like, how do you know at the end of the month if you're actually making money or if you're just spinning your wheels? Well, today we are going to decode that exact journey. Here is our roadmap for today. We've got 5 steps. 1, the transaction engine. 2, the accounting diary. 3, sorting it out. 4, the balancing act. And finally, 5, discounts and expenditures. Okay, let's dive into this. Section 1, the transaction engine, the frontline worker. So think of the transaction processing system, or the TPS for short, as the digital cash register of your business. It's basically the frontline worker processing everyday transactions right in the normal course of business. We're talking about receiving orders from customers, processing shipments, paying your employees. It is pure, raw operational activity. And notice that it's not used to make strategic decisions. It just captures the action right as it happens. Moving right along to Section 2, the accounting diary, journals, translating actions into accounting. Now, since a massive pile of raw receipts isn't exactly enough to build a real financial strategy, we have to turn to the journal entry. Conceptually, you can think of this as your business's chronological diary. It's the method used to formally record your accounting transactions day by day as they happen over the course of a month, and it lays them all out neatly in a statement format. Now, what's really interesting about this example is seeing it in action. Let's look at Saharith SDDBH. They're a newly established company selling floor tiles over in Ipoh, Perak. If we look at their April diary, well, on April 10th, they start the business with $500,000 in cash and a vehicle. Then on the 13th, they pay office rent. On the 22nd, they sell inventories on credit. You see, it reads exactly like a chronological story of the month. To format this chronological story, we rely on this standard double entry system. This is the golden rule. Every single transaction requires a minimum of 2 accounts, a debit and a credit, and they have to occur on the exact same date for the exact same amount. It is literally the fundamental law of balance in accounting. Let's actually trace how Zarif's actions are translated using this rule. Take a look at April 11th. They transferred $400,000 in cash into the bank. In the journal, we see a debit to cash at bank on the left because obviously the bank gained value, and a credit to cash in hand on the right because their physical cash decreased. Or look down at April 15th. They bought furniture, computers, and printers by check. Those assets are debited on the left, and that single payment from cash at bank is credited on the right. Every action has an equal and opposite reaction. Which brings us to Section 3, sorting it out, ledgers, the categorical filing cabinet. Here's the thing. A chronological journal makes it notoriously difficult to pull a specific metric, like, say, your exact cash balance on a random Tuesday. To solve this, we actually move data out of that chronological timeline of the journal and drop it into specific sorted folders known as ledgers. So if the journal is the diary, the ledger is basically the categorical filing cabinet. The accounting ledger is essentially a collection of all these specific T accounts prepared on a monthly basis. And the posting rule here is super straightforward. Debit entries from the journal stay on the debit side of the ledger, and credits stay on the credit side. The data simply changes homes. It doesn't change identities. And this brilliantly illustrates the concept. Here is Zarif's specific cash-in-hand ledger folder. On the debit side, we see the RM500,000 starting capital from April 10th, and the RM13,000 from sales on April 25th. Then, on the credit side, we see the RM400,000 transferred to the bank, the RM5,000 for rent, and so on. See what happened? All the cash activities, plucked from totally different days in the diary, are now sitting together in one clear, categorized space. All right, Section 4, the balancing act, proving the math works. So the crucial point here is that to find out exactly where the business stands at the end of a month, ledgers must be closed out. Notice the specific terms used: balance CD, which stands for balance carried down, and balance BD, which stands for balance brought down. These are basically the mechanical gears rolling one month's reality into the next. Let's actually walk step by step through the mechanics of this using Zarif's cash-in-hand account. Step 1, we total both sides. The debit side totals RM 513,000, but the credit side only totals RM 405,850. Step 2, we find the difference, which is RM 107,150, and we insert it as the balance/D on this smaller credit side. Step 3, now both sides beautifully add up to an equal RM 513,000. Finally, step 4, that 107,150 closing balance is carried down to the opposite side, the debit side, as the balance BD to open the month of May. So we now know, undeniably, that Zahareff starts May with exactly $107,150 in cash. Let's move to Section 5 and see how this builds. Discounts and expenditures, crucial nuances. In the real world, there are some specific operational nuances that often trip up beginners. Take discounts, for example. There is a massive difference between a trade discount and a cash discount. A trade discount is really just a price reduction given by a seller at the point of sale. Like if a RM100 tile is on sale for RM80, you just record the RM80. The discount itself is completely invisible in the accounting records. But a cash discount is a totally different story. This is a reduction given to a customer for the early repayment of a debt. And because the original debt was already recorded in the ledger, this new discount must be tracked and recorded as either a discount revenue or a discount allowed expense, just to make sure the math balances out. The second vital nuance is how you actually spend your money. You absolutely must differentiate between capital expenditure and revenue expenditure. If you buy a new asset that's going to serve the business for years, like, say, purchasing an additional lorry or building a new water tank, that is a capital expenditure. It increases your total assets. But if you're just paying day-to-day costs to maintain the business, like repairing a broken factory roof or paying a cleaning service, well, that is a revenue expenditure. It's an expense that lowers your current capital rather than building long-term value. Mixing these two up will completely distort the health of your business. And that brings us to the ultimate question. How do your daily business activities ultimately impact the ultimate equation? Assets equal capital plus liabilities. Every receipt, every bank transfer, every journal entry, and every balanced ledger, they all flow upwards into this one inescapable accounting equation. So I challenge you to look at your own business or the company you work for through this newfound mechanical lens. The next time you pay a bill or make a sale, ask yourself, how is this single daily action tilting the scales of that ultimate equation? Because understanding that connection, well, that's the true language of business. Thank you so much for joining me on this explainer, and keep learning.